Janet Yellen warns of economic and financial catastrophe if the debt limit is not raised in an exclusive interview with Bloomberg at the G7 meeting in Japan. President Joe Biden and House Speaker Kevin McCarthy postponed today's debt ceiling meeting as staff-level talks are set to make progress. Stock futures are up. But meanwhile, JP Morgan Chief Executive Officer Jamie Dimon warns that a U.S. default would be potentially catastrophic. We'll have more from our exclusive interview. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the U.S. Treasury Secretary Janet Yellen says a debt ceiling solution will be good for the economy and the markets. While she sat down in an exclusive interview with Bloomberg's Annmarie Hordern just moments ago in Japan.
There is no satisfactory solution for the United States, a solution that will be good for the economy and financial markets, other than Congress acting to raise the debt ceiling. There are potential different paths that could be taken if that doesn't happen, but there is not a single thing that can be done that will save the United States from considerable economic and financial damage.
But this plan was outlined back in 2011, and you were there at the FOMC meeting about it, and it said that Treasury principals and securities would be paid. Is this something that, at least for contingency plan, has been discussed with the president?
So my understanding, I was at the Fed in 2011, is that this plan was never presented to the president and never approved. And
but would you present it now?
Look, we would. We are working full time to work with Congress to raise the debt ceiling. That's where our focus is. We know that the only good outcome is one in which Congress acts as it has many times, almost 80 times since 1960, to raise the debt ceiling. What global markets and American households and businesses need to see is that we have a Congress that's committed to paying the bills that we've incurred as a consequence of our legislation, that we're not a deadbeat country. And if Congress fails to do that, it really impairs our credit rating. We have to default on some obligation, whether it's treasuries or payments to Social Security recipients. That's something America hasn't done since 1789, and we shouldn't start now. So we've not discussed what to do. If that doesn't occur with the president, our focus is on getting it done.
Because as you know, treasuries are the bedrock of the global financial system. And the asset managers I speak to, the investors, they don't have the luxury of not contingency planning. So at this point, should they assume that debt may not be serviced if there's no deal?
Look, if Congress doesn't raise the debt ceiling, we face economic and financial catastrophe one way or the other. And that's why our focus is on making sure that Congress does raise the debt ceiling. I feel that that's something we're going to succeed at doing, and we're working hard to make sure that that gets done.
Well, that was Treasury Secretary Janet Yellen speaking exclusively to Bloomberg, thanks to our Annmarie Hordern. Now, joining us now is Marie-Jacques Cardoen, Chief Executive of Edmond de Rothschild Asset Management France. Marie, thank you for joining us. The debt ceiling, I mean, a lot of the market for the moment, apart from certain parts of T-bills and things like that that are on the move, is largely ignoring it. What's worst-case scenario?
There clearly is a risk of zero risk of the U.S. defaulting on their sovereign debt. The market is pricing it. The U.S. CDS is at 176 basis points. It was 77 in the summer of 2011 when the U.S. got downgraded by S&P, and it's been on average historically around 20. So clearly, the market is recognizing that there could be a risk of default, whether it's a short one or a long one. It's difficult to say. That's not our primary scenario. We believe
so you think
that
they'll find a deal.
They will find a deal. We, need to remember that negotiations between President Biden and McCarthy have only just started. They've met a couple of days ago. They're about to meet again. And it is likely that political antagonism is going to increase before a consensus is reached. But looking at the historical data, we believe that it is likely that a compromise will be found.
So from now until the 1st of June, and frankly, it's unclear what options the Treasury has. It's unclear also when the debt limit is. So it's all a bit, like the French say, it's a bit flou, right? It's a little bit vague exactly what happens and when it happens. Are you expecting just much more stress on the markets, and how do you play that?
We're expecting more volatility building up to a consensus being found. Look, we've been positioning portfolios accordingly. We've been quite conservative, not only in the rate space, but also with regards to equities, where there are fears of a recession globally, and we've been positioning our portfolios and favoring corporate bonds over equities for a while. We have taken advantage of government bond yields increasing, and we've increased duration gradually.
And is this, when you're saying what you're buying, is it for Europe or actually as a whole? If you look at region by region, of course, they're performing all quite differently.
There are, of course, regional specificities, but I would say overall, we've been very cautious in portfolios in Europe and in global portfolios as well.
So what do you do with gold?
Gold is an exciting asset class. It's always been a refuge in times of uncertainty. I think the recent events on the geopolitical front or macro front have clearly brought the asset class to a level where we see a very good forward as well. There's several reasons to it, but I think the appeal for gold has risen. The first one is uncertainty, which we think is poised to remain. The second one is central banks will get to slow down their tightening policy at some point, and that's going to benefit gold.
This year, I mean, we're also talking about a cut from the Fed, which a lot of people are pushing back against.
That's not our expectation, and clearly that's not the indication that the Bank of England has given. They want to be evidence-based, and they will wait to see how the cuts are impacting the real economy. But we think that the Fed is going to pause their indicators that are clearly showing that it's time for a slowdown in the rate cuts. I think one of them is the CPI in April. It came at 0.4%. The undercore inflation came at 0.2% month on month, which is showing that inflation is slowing down and that there could be a pause in the tightening.
So, why do you see a difference between what the market is expecting, which is a cut from the Fed, and I guess their models are showing that there's a monetary lag by about 12, 14 months. So by the time that they started the first cuts, it's starting to play out now, and so we're going to see a seizing of the economy, a kind of credit crunch, and Fed officials, but also economists pushing back against that.
So I guess we have to obviously differentiate between Europe and the UK and the US. We believe that Europe and the UK are 6 months behind in terms of seeing the results of the monetary policy on the real economy and on inflation. In Europe, the inflation came at 5.6%. In April, so that's kind of a slowdown, but it's more of a base effect given the levels of last year, we believe, so no real effect yet. Whereas in the US, we think that there clearly is this antagonism between, yes, we're seeing a slowdown in inflation, so potentially a monetary policy that is going to be a bit more lenient going forward, but then we need to remember that there is this huge fear of recession, pressure on regional banks, and that will continue to weigh on investment.
And we saw actually in the data points out of the UK today, the consumer softening a little bit. Have you been surprised that that the consumer in the UK, in France, elsewhere, almost globally, has held up so well so far?
I would say we were expecting the consumer to hold quite well through the last couple of months, but we believe that there is clearly a case for a big slowdown coming up, and that's the expectation. hence the very cautious stance that we take on equities, despite the very good results that companies have shown in the first quarter.
Annmarie, thank you so much for joining us. That was Annmarie Jacot-Cardoen, the Chief Executive Officer of Edmond de Rothschild Asset Management France. Coming up, we'll also be speaking to Daniel Kaplan, the Chief Executive and co-founder of Storskogen Group. That's after their earnings beat. It's interesting because we'll talk about supply chain, and they're also acquiring quite a lot of companies. So he's next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Storskogen Group shares jumped after the Swedish investment company posted better than expected first quarter results. So joining us now is Daniel Kaplan, the Chief Executive Officer and co-founder of Storskogen Group. You have three businesses. Daniel, welcome to the program: trade, industry, and services. Now, I had to take a double take because we say that shares are gaining, but they're up 18%, I think, in today's tracing session, up 1.8%. I mean, does that make you feel good about the future?
I'm of course happy that the market appreciates our report. I think we had a very strong quarter in many respects, but of course it's a complex macro environment, so we just have to keep on our toes and keep working in the future going forward.
So what do you think actually investors are really liking right now? I know you beat estimates, you have a pretty strong beat on EBIT as well. Is there, how's the trend looking like? In the next 6 months, 12 months, are you expecting to be on the same trend?
I mean, in this first quarter, we had a 56% increase in adjusted EBITDA. We had an earnings per share growth of 118% and strong cash flows. I think we're very happy with that. We're also, from a seasonality perspective, we are expecting a strong second quarter. Beyond that, we're very cautious about giving projections. I think the macro environment is very uncertain, so we are humble to the fact and want to deliver in those circumstances before we promise anything.
I mean, your business activity, for example, so you own companies across many industries in the Nordics, but you also have companies in the UK, Germany, and Switzerland. What worries you the most about what some of these economies will go through? Is it disruption? Is it consumer and recession? Is it macro trends?
I mean, of course, each and every country and each and every industry is different. But I think from Storskogen's perspective, a key part of our business model is diversification. So our three business areas, they are actually, we have a negative correlation between trade and industry, for example. So at the moment, industry is doing really well, whereas our trade companies, they're suffering from weaker consumer confidence. So I'm not necessarily worried about any particular macro or micro trend. But of course, if we have a general global recession, that will, of course, affect us. So I would say continued inflation and high interest rates, I think that would be negative. But I wouldn't say I'm really worried about that.
You're also a serial acquirer, which, I don't know whether you accept being called that or not, but are you seeing more values? As there's a recession, usually values of companies go down, so you could find bargains. How much money do you have on future acquisitions?
I mean, we did more than 50 acquisitions last year. We have reduced M&A pace this year. We've done 6 acquisitions so far this year. I think, we are only buying strong cash flow generating companies, very successful. As a rule, the prices in the unquoted SME segment, it doesn't really go up in good times, and it doesn't really go down that much in bad times. So unfortunately, we don't see that many bargains in our market, but and actually we see a somewhat decreasing deal flow when times are tough. But I think we will gradually start to do more aggressive acquisitions later on into the year. But at this point, our primary concern is to reduce leverage, actually, and in a high interest rate environment.
I mean, just so that people understand, you have around 12,000 employees, you have 136 business units divided into 14 verticals. Given the high debt load and uncertainty in the markets, is there anything that you would like to sell off, that you would like to divest yourself of?
I mean, we're continuously reviewing our portfolio. If we find that companies are not aligned with our financial strategy, they could be underperforming, they could have high earnings volatility, for example, or not be coherent with our ESG agenda. I think in that case we would divest them over time. I think that's for sure. So we are,
Which
but
ones
not
are...
any particular area at this point.
I was going to ask you, is there any particular sector that you think would be, a good idea to get rid of?
I think industries that are structurally with potentially too low margins or very high cyclicality, I think those would be more in jeopardy, if you will. I mean, those companies have been great to own and been contributing to Storskogen, but as a quoted company, we just recently quoted ourselves 18 months ago. I think in a quoted environment, they suit us less good, so to say.
You also have, of course, a sizable
without being
bond
more
maturities.
specific.
Okay, yeah, I knew I was going to get
yes.
more on that, Daniel. So I wanted to ask you about, some of the bond maturities that are coming up. They're quite sizable, certainly in 2024 and 2025. Given the jump in yields and the jump in borrowing costs, how are you going to, I guess, move and tackle this looming debt wall?
Yeah, I mean, we actually have a very strong liquidity. It's about 9 billion Swedish kronor in cash on hand and unutilized credit facilities. We extended our big RCF, revolving credit facility, and a term loan as well to 2025 with an extension option as well. So we're not particularly stressed. If you look at the upcoming, we have one bond in 2024 of 3 billion. We already more or less have cash at hand to repay that if we would want to. But I think for us, we would want a nuanced debt maturity profile, evenly distributed across a number of years. And of course, we're working to amend that. And I think we feel pretty confident, especially with the very strong cash flows that we are experiencing at the moment.
Great, Daniel. Thank you so much for joining us. Daniel Kaplan there, Storskogen Group Chief Executive Officer and co-founder. Coming up, Turkish voters head to the polls this Sunday. We'll get the latest from Istanbul ahead of a crucial election. That's next, and this is Bloomberg. Turkish voters head to the polls this Sunday for the country's general election. Well, the race is expected to be a tight one amid growing economic concerns. Now, for a preview, let's go out to Istanbul, where Bloomberg anchor Yusuf Gameldin is covering the story. So, Yusuf, a prominent presidential candidate dropped out. Where does this leave the race? How uncertain are the votes?
I mean, Fran, you have Muharrem Ince, who decided to throw in the towel, and this is after there was an alleged sex tape. Also accusations that he took some bribes. He's firmly rejected all of that. But what it does do, it narrows the race to three contenders. The incumbent Recep Tayyip Erdogan, you've got the ultra-nationalists, and then also the credible threat that has emerged, and that is Kemal Kılıçdaroğlu. Two things I want to point out here that we haven't discussed as much throughout the morning. One is, regardless of outcome, what is the transition going to be to a new administration? If the vote is as close as we hear it's going to be, and with either side winning or whichever side wins, what's the handover going to be? Are there going to be attempts to contest the outcome? That is a concern on the one side. The other side is you have an economy that can't afford to wait, with $177 billion that have been spent to try and micromanage the currency. And then another front that I'm watching as well in some of the discussions I've had is Turkey's evolving role as a foreign actor rather, and what we've seen in terms of a shift that allows it to play a role and to continue to talk to Russia. The relationship with the United States has been very tense throughout this morning. Actually, we've had more accusations from Turkish opposition that there has been some level of meddling from Russia in Turkish political affairs. So that is something that weighs and ultimately is going to lead to a bit of a rethink, at least in terms of the United States. For the Turkish side of things, it is clear that the relationship with Russia is important. They supply natural gas, tourists, and other inflows as well. Fran.
Yusuf, thank you so much. Great reporting there on the ground. Our Yusuf Gameldin in Istanbul. Of course, he'll be covering all of the election for us throughout the weekend. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Sources tell Bloomberg that at least 8 senior Credit Suisse bankers are leaving the firm for Santander. Mergers and acquisition chief Steve Geller is said to be amongst them. We are told the move reflects how Santander is expanding over in the U.S. Representatives for Credit Suisse and Santander have declined to comment. Now, the Wall Street Journal reports that Linda Yaccarino, NBC Universal's head of advertising, is in talks to become Twitter's new CEO. Elon Musk tweeted he is transitioning his role at the firm to executive chair and CTO, where he will oversee product, software, and also systems operations. Musk says the new CEO is slated to start in about 6 weeks. And Peloton shares plunged after announcing a recall of around 2 million bikes over safety concerns. Shares dropped to their lowest level since the fitness company's 2019 IPO. A flaw in the seat post was identified earlier this month, and Peloton says it will provide replacements that consumers can install themselves. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. European stocks for the moment are rising. We did have a couple of earnings that actually beat estimates. Luxury group Richemont definitely rallying to a record following estimate-beating results. Pound also edging higher after data showed that the UK economy grew slightly in the first quarter, and that's reducing the risk of a recession. Now, Bloomberg Surveillance Early Edition continues in the next hour. Kriti Gupta in New York, Tom McKenzie here in London, and this is Bloomberg.
If Congress doesn't raise the debt ceiling, we face economic and financial catastrophe one way or the other.
The president's made clear that we cannot default on our debt. We can't default on the promises we've made to our creditors.
No one really believes that the U.S. will default, and they shouldn't either.
Actual default. I don't think it's going to happen because it gets catastrophic, and the closer you get to it, you will have panic.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It is 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Janet Yellen warns that the only good outcome in the debt standoff is for Congress to raise the ceiling. The Treasury Secretary talks with Bloomberg in an exclusive interview. Fixed income traders at SocGen beat their peers in a volatile first quarter. That made up for a plunge in equities trading revenue. And a crucial election in Turkey on Sunday. An opposition alliance tries to end Recep Tayyip Erdogan's 2 decades in power. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Kriti Gupta in New York. Anna Edwards is off today. And Kriti, investors, the markets finding some reason for cautious optimism this morning.
A little bit, but look, it's coming in the context of a weak week. There's been a lot of red on the screen when you look at the S&P 500, so it's only natural that we're due for some sort of bounce. That is kind of the sentiment you're seeing in futures right now, higher by 0.4%. That is the biggest margin that we have seen all week in either direction. So it really speaks to the idea that even though on the surface the S&P 500 does feel a little bit range-bound, essentially waiting for the debt ceiling talks and something to come of them, especially now that the meeting has been postponed to next week between Speaker McCarthy and President Biden. The markets are saying, look, maybe we need to trade on technicals. Maybe we need to trade on just kind of other liquidity forces that are now baked into the market. And that is just the stock market story, Tom. You got to look at the bond market as well. 391, that's a theme of stagnation, that theme of kind of sitting still in the water and waiting for some sort of direction in an era where the Federal Reserve is pretty much thought to have been done tightening. We're still looking at a 2-year yield that's at 391, hovering around that range between 391 and 405, really on the lowest end of the range right now. But again, sitting back and waiting seems to be the theme of the day. You're even seeing that in the Bloomberg Dollar Index as well, really at the whim of anything that is going on abroad. Even NYMEX crude not giving us much to work with here, down about 0.4%. Tom, it kind of feels like everyone's checked out for the weekend.
You do get that sense, don't you? Here in Europe, there's a little bit of focus on the earnings story because there's some optimism in some of the individual names, even as we gear up for that well-earned weekend, at least for most of us. Richemont, for example, we'll break that down for you shortly, but also SocGen as well. Here in the UK, some economic data coming out, really interesting given what we heard from the BOE, that raising of forecasts for growth for the UK. In the first quarter, we did manage to eke out 0.1% growth. It's pretty meagre, but the growth was there in the first quarter. A slight concern about the most recent months coming through for the UK. Across the European session, then you're seeing gains of 0.7%. So far, it's a pretty solid session, taking a beat, of course, in terms of a little bit of optimism, the geopolitics coming through from China and the US with those talks, and also the debt ceiling, of course, and those conversations being pushed on, and the needle moving, at least on the edges, the margins. 125 on the pound, that's a gain of 0.2% as we weigh up that GDP print, of course, on the back of that BOE decision yesterday around raising rates by another 25 basis points. Richemont, look at that, soaring 7.7%. The owner of Cartier, of course, doing really well in terms of sales in China. It is, again, the China story when it comes to luxury goods, and they've come out with a very solid beat, about 5 billion euros in revenue for the first quarter. And whether or not that the dynamic comes through and continues out of China is going to be crucial, of course, for the luxury space and Richemont as well. THG, very different story. This is a business listed here in the UK. They own dozens of websites focused on lifestyle and beauty. They were in conversations with Apollo Group around a potential takeover. Those conversations have ended, the stock plummeting 11%. This is well below its IPO price, trading at about 66 pence. It had been IPO'd at about £5. So well below that, the travails of this business, THG, continue. Kriti.
Well, it's interesting. On the micro front, we are seeing quite a bit of movement. That's been a theme all week. But on the macro front, stagnation, waiting for some direction on the debt ceiling seems to be the theme, which brings us to our top story. President Biden and House Speaker Kevin McCarthy postponed their meeting on the debt limit. It was set for today. The delay signals that progress has been made in talks between staffers aimed at averting a catastrophic U.S. default. Treasury Secretary Janet Yellen discussed the topic in an exclusive interview with Bloomberg's Annmarie Hordern at the G7 summit in Japan.
There is no satisfactory solution for the United States, a solution that will be good for the economy and financial markets other than Congress acting to raise the debt ceiling. There are potential different paths that could be taken if that doesn't happen, but there is not a single thing that can be done that will save the United States from considerable economic and financial damage.
Annmarie Hordern joins us now from Niigata, Japan. Annmarie, 2.5 weeks until that June 1, early June deadline. What happens next? We all know it's catastrophic. What can really be done here?
So what Treasury Secretary Janet Yellen continues to repeat is that there are no good options besides Congress acting. But of course, when you speak to individuals in the global financial system, they're starting to prepare for contingencies. Now, she said there are a number of paths open, but she would not confirm or deny this idea that really took shape in 2011 at the Treasury, which is that they would make sure that debt would be paid on principals and on Treasury securities before they paid anything else. And this is something that potentially is a contingency plan, but she doesn't really want to voice or advocate for that now because in her mind, there is no good plan besides raising the debt ceiling so that the U.S. government could pay all those bills. Remember, this can become very politically fraught for the president, and if he needs to decide whether or not he's going to pay interest on bonds or Social Security checks.
Yeah, choices clearly none of them in the administration want to be forced to be making. The Secretary Yellen also speaking about the recent string of bank failures. Take a listen.
The banks that have failed have had some very unique characteristics that have made them vulnerable. The banks that failed tended to have substantial losses, mark-to-market losses on their hold-to-maturity portfolios. So although their regulatory capital wasn't impaired, their tangible equity was diminished, and they simultaneously had a very high proportion of uninsured deposits.
And Annmarie, you pushed the Treasury Secretary on this. You flagged the fact that she'd mentioned repeatedly that this is a stable US banking system, and she tried to ring-fence the regional banks once again.
Yeah, that's right. Whether or not it was the first bank that failed just 2 months ago or the fourth more recently with First Republic, the administration has continuously come out and said the banking system is sound and resilient. But here, obviously, she is talking about the pressure that is facing regional banks specifically. She would not rule out whether or not we could see another small or medium-sized lender collapse. But at the same time, she does think that they could have access to ample amount of liquidity, and by and large, she thinks the U.S. banking system is strong. We should note, it is not lost on me or anyone else here at the G7 that two of the biggest concerns about economic risk are stemming from the United States, the banking crisis as well as obviously the debt ceiling. And we just heard from the German finance minister who says he hopes that Washington takes a mature decision, because it is not just investors in America, politicians in America that are waiting for some sort of deal as we head towards June 1st, but it is globally a massive issue and serious concern because, of course, you know, treasuries underpin the entire global financial system. So it's quite something when the Treasury Secretary shows up at an international meeting and they're supposed to be talking a number of topics, but the two that are front and center are emanating from Washington.
Certainly putting a lot of pressure on both the markets and Washington as we get closer and closer to that deadline. 2.5 weeks away. Annmarie Hordern in Japan, we thank you as always. We'll, of course, bring you more from Annmarie's exclusive interview with Janet Yellen later this hour and throughout the day on Bloomberg Television and radio. In other banking news, Societe Generale's fixed income trading unit outperformed most peers in a volatile first quarter. Clients reacting to interest rate hikes spurred revenue in an otherwise tough trading period. In his last interview as the bank's leader, SocGen CEO spoke with Bloomberg exclusively on the fallout from the U.S. banking turmoil.
The situation is very different. So yes, the situation can remain volatile with turbulences going forward, but I don't think there's a spillover to be expected in the European banking market.
Sonali Basak, our global finance correspondent, joins us now for more. Sonali, walk us through the details here.
Well, it's interesting to see SocGen really blow it out of the park when it comes to fixed income trading here. Because when you look at the European banking landscape, the U.S. giants are much bigger in trading, but they're doing quite well in fixed income trading. We know a lot of banks are moving into France, to Paris. It's becoming a much bigger global financial center. So on that hand, trading kind of blowing it out of the park here when it comes to rates trading in particular is interesting to see as these French banks gain more share in trading. However, we also know, according to Bloomberg intelligence data, that SocGen is trading at the lowest price to book value of every really major European bank here. And so the strategic direction of the bank as it transitions leadership is really the story to watch for SocGen over time. What does this bank do? What does it mean? How does it change? How does it improve its profitability over time?
OK, so from one of the major European banks to one, of course, the preeminent US banks. And that exclusive interview we had, of course, with Jamie Dimon, JP Morgan's CEO, of course, yesterday, telling Bloomberg, telling Francine Lacqua that regulators should consider a short-selling ban on banks.
The SEC has the enforcement capability to look at what people are doing by name in options, derivatives, short sales. And they should go, if someone's doing anything wrong, people are in collusion, or people going short and then making a tweet, about a bank, they should go after them. And vigorously, and they should be punished to the full extent the law allows it. So I think it's possible it's taking place. We have no evidence of it.
Sonali, is this a surprise? What do you make of this?
It sort of is a surprise because you did hear him even go against what his own bank is seeing in some regards when you look at what is happening in short selling. But what he is saying is something that is on the minds of many people. This is a very volatile banking system here in the United States. I would refer also back, we spoke to Jim Milstein, who is an executive at Guggenheim Securities, who has been advising the FDIC on a lot of these bank failures and sales here, who had said that the SEC should step in, maybe not with full sale bans, but disclosures here. So how the SEC moves on what is happening underneath the surface in trading of these firms is of key concern in a lot of different ways. I would also say they are looking at not just short selling, but how executives are trading stocks of the firms that they're involved in this very volatile time where disclosure is pretty paramount and irregular at this point in time as people watch deposit flows.
Sonali, of course, Jamie Dimon has also spoken about first undying confidence in the U.S. consumer, then talking about the economic hurricane. Now he's saying, look, a mild recession seems to be his base case, but he said he's more worried about geopolitics. J.P. Morgan has had a very fraught relationship with China. Is that changing?
Well, it's interesting because actually when you look at the regulatory concerns when it comes to the banking system, it's not the chief concern. It's geopolitics. That is a much bigger one. That is everything from the changing trade relationships from the U.S. to Russia around the world. And also when it comes to Taiwan. He didn't mention Taiwan explicitly, but we know in the past year, U.S. lawmakers very explicitly asked him, Citigroup CEO, Bank of America CEO, about what they would do if geopolitics and concerns between China and Taiwan were to escalate. Now, again, regulatory-wise, you don't see a major crackdown on the financial system in the same way as you see in technology, and he pointed that out. But certainly, when it comes to the U.S. banking system moving further into China, it has been a fairly slow move, but one that is J.P. Morgan, Citigroup, a lot of these big banks have committed to over time.
And let's see if those relations maybe thaw just a little bit and where Jamie Dimon stands on the other hand. Bloomberg Sonali Basak, we thank you as always walking us through the crucial stories in the banking world. A hard pivot here from New York to Turkey. Turkish voters head to the polls this Sunday for the country's general elections. The race is expected to be tight amid growing economic concerns. For a preview, let's get out to Istanbul where Bloomberg's Yusuf Gamal Eldin is covering the story. Yusuf, set the scene for our international audience. Talk us through the policy at stake this election weekend.
Well, it's all about who gets to be in the driving seat of one of the world's largest economies, $900 billion worth. And it's been a tough time, as you said. And here on the ground, the tensions is very palpable. On Sunday, the voting stations are going to open at 8 a.m. in the morning. Quite a few things to run through in terms of some of the issues that are at the center of the local debate, be it political or economic. I think you look at the lineup of contenders. You've got the incumbent. He's been around for 20 years, Recep Tayyip Erdogan. No surprises there. The credible threat emerges this time around, which is why this is a little bit different. I've been doing this for a while now. This is Kemal Kılıçdaroğlu. And with the Muharrem İnce group now throwing in the hat, you only have three contenders and two main challengers, or two at least that appear to have crystallized, that are going to take this down to the wire. If we don't get a decision on Sunday, this could go to a runoff May 28. The lira hedging is now at a record. You have the actual spot trading that is also at a record low. And foreign investors have left waiting to see whether we get clarity or not. So that is what this is all about.
What about the geopolitics? Fold that into that as well, Yusuf. Obviously a member of NATO, Turkey, but increasingly under Erdogan, close to Russia.
I mean, this has been fascinating to watch because at the end of the day, Turkey is actually NATO's largest military after the United States. And what has happened since 2016, since the alleged coup attempt, President Recep Tayyip Erdogan has moved away from the United States. There's a deep mistrust. And by moving away from the United States, he's actually moved closer to countries like Russia. He's got the ear of the Russian president. And in some ways that has been useful, for example, with the grain deal vis-a-vis the Ukraine. But there's a broader reluctance, not just from Erdogan, but from opposition chiefs to sanction Russia. Natural gas comes from Russia. There are a lot of tourists that still come from Russia and inflows from other sources as well, and nuclear know-how. So this is not going to change anytime soon, and it's going to keep the United States and Europe watching this contest very, very closely over the next 48 hours, guys.
OK, on the ground for us in Istanbul, Yusuf Gamal Eldin previewing the first round of that really important vote for Turkey. Sunday is the first round vote, and of course the importance domestically for Turkey, but internationally as well, as Yusuf was outlining for us. Coming up, we're going to speak with Beata Mante, Citi's head of European equity strategy, as investors remain focused, of course, on what central banks will do next in their rate hiking campaigns. Bank of England Governor Andrew Bailey spoke to Bloomberg yesterday.
we are approaching, a point when we should be able to, in a sense, rest in terms of the level of rates. But we haven't seen the evidence yet to give a stronger sense of the read of that. So that's why I'm very clear that we have to be evidence-driven.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Tom McKenzie in London. Look, it's all about the debt ceiling on the macro front. And there's a really interesting chart that I want to show you immediately. For our radio audience, stick with me. Immediately, when you think that maybe the U.S. government may just default, you go back to 2011. You say maybe the go-to trade is at the end of the day to pursue, ironically, the safest asset in the world, which is U.S. Treasuries, and therefore yields should go down. Well, it kind of feels like as we start the countdown clock to that early June deadline, that is exactly what's happening. For our radio audience, stick with me here. We are looking at a chart of bid to cover ratios for the latest auctions. We're looking at 4-week auctions, 8-week auctions, even 30-year auctions. And it's kind of a messy chart. But what you need to know is this very last panel right here, where you see a tick up in all three tenors. It really speaks to the idea that even though we are kind of counting down, there is that panic that is baked into the markets. People still want treasuries, but is that the trade that makes sense? Or do we go in the other direction? Do you go with the fundamental trade, which is essentially to short or to cover or to hedge against that U.S. default? Let's bring in a true expert. Simon White, Bloomberg macro strategist, joins us from London. Simon, if everyone is hopping into treasuries, does that mean the yield peak is in?
Well, I think it's quite possible. I think the chart you show there is very interesting. You have bid to cover ratios this week on very short-term Treasury securities, so like bills, and very long-term bonds, like the 30-year. And I think there's two reasons for that. First of all, people are buying like 1-month bills. Now that's going over the potential X day when the US might have to quote-unquote default. It probably won't actually default, but there is some sort of risk there. And that's probably people just taking advantage of the fact that these bills are trading very cheap. Whereas in the longer term stuff, I think it's a safe haven thing. Perversely in the US, even though you have this potential debt ceiling thing, happened in 2011, 2013, even though that was the center of the risk, if you like, people gravitated towards it because there's no other opportunity. If you're looking for a safe haven, even if it is a US debt problem, all you've really got is US debt. And so that's why people are looking at the longer term stuff as well.
So 375 on the 30-year, 340, so a 50 basis point move, or at least 50 basis point differential between the 2-year and the 10-year in the US. And you mentioned the bill growth trade around short-term T-bills. Where do you see those yields going then at the 10-year, 30-year level?
Well, I think this is an opportunity for a short opportunity for longer term.
So that window's going to close?
Yeah, I think so, because look, I think there's a number of things happening here. So safe haven or not, people are now focusing on the US fiscal situation much more closely. Now, the fiscal deficit in the US is running at negative 8%, so 8%, and that's even before we've hit a recession. And that's also the largest of all the major countries in GDP terms. So we've already got a pretty poor fiscal situation in the US to begin with. People are beginning to focus on that. Top of that, you basically have global interest rates are peaking, short-term interest rates are peaking. That actually counterintuitively means the 10-year tends to rise, the yield tends to rise, because that's the signal of a global cyclical upturn. So you're beginning to see these sort of changes in the cycle. And I think right now, yields are going to go higher.
Great stuff, Simon White. Thank you very much indeed from our macro team, of course. For more market analysis, do check out MLive Go on your terminal. Stay with us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Janet Yellen warns that the only good outcome in the debt standoff is for Congress to raise the ceiling. Treasury Secretary talks to Bloomberg in an exclusive interview. Fixed income traders at Societe Generale beat their peers in a volatile first quarter that made up for a plunge in equities trading revenue. And a crucial election in Turkey on Sunday. An opposition alliance tries to end Recep Tayyip Erdogan's 2 decades in power. A lot to digest there. I'm Kriti Gupta in New York with Tom McKenzie in London. Anna Edwards is off today. Tom, there is a lot to digest on the macro front. Geopolitics at the core of not just the election in Turkey, but of course what Jamie Dimon is saying is his biggest concern as well. Meanwhile, all eyes on the debt ceiling stateside.
Yeah, slivers, I should say, of optimism as those talks between, at least at the staff level, continue. We're a long way, of course, from any kind of resolution, and the Treasury Secretary just ramping up the warnings on that front. But talking the geopolitics as well, of course, around China, you do have the news reported by Bloomberg that there have been some conversations between China, Wang Yi and Jake Sullivan. 8 hours of talks. Maybe that's setting the stage for a meeting between the two presidents. Maybe that's going to ease the geopolitics and the tension between Beijing and Washington, at least at the edges. Across the European markets, you're also seeing a bit of a lift from the earnings front. So gains of 0.6%. And we can zero in on some of the individual stories. But before we do that, let's check in on the pound, because you're seeing a bit of strength coming through for sterling. 0.2%, 125. You had some economic data suggesting that for the first quarter, you did get a little bit of growth, marginal growth, 0.1%. That after, of course, the Bank of England raised rates by 25 basis points and increased their forecast for growth for the UK economy yesterday. Here's one of the earnings stories that's really important and really interesting. It ties back to the China story, but not on geopolitics, on the demand for luxury. So Richemont, the owner of Cartier, seeing sales just being propelled in the world's second largest economy. Whether or not that is sustained is going to be crucial. But so far, the gain of 6.4%, investors rewarding the earnings beat coming through from Richemont, and one of their biggest shareholders also pushing back on speculation that LVMH may be looking to snap up this business. THG, a very different story. This beleaguered UK-listed company, it operates websites focused on things like beauty and lifestyle. They were in talks with Apollo Group. They've cancelled an end of those talks. The stock taking a big hit, currently down 9%. The travails of this business well below its IPO price. THG listed here in the UK. Kriti.
Yeah, certainly a lot of volatility on the micro front. On the macro front, though, Tom, it does feel like a little bit of a snooze fest. But here's what happens in a snooze fest. It means that the market is far more vulnerable to technicals, to liquidity, to supply. And that's exactly what you're seeing in S&P futures right now, higher by 0.5% on the background that, look, we have had losses for most of this week, especially in the pre-market trading session. So when you were looking at it from a macro perspective, we were almost due for some sort of bounce. And that's exactly what you're seeing, higher by 0.5% in futures. The bond market kind of singing to the same tune here. 390 on the two-year yield. You're starting to see some of the gains, or I should say some of the losses in the Treasury market, some of the gains in the yield pared back even in the pre-market session. Right now we are unchanged, but the direction of travel seems to be a bid into bonds. That's going to be a theme you see as we get closer and closer to that debt deadline in early June. And of course, that's going to also yield the dollar story, or lead the dollar story, excuse me. Right now, the dollar at the whim of, like you just mentioned, the pound as well. But again, waiting to see what comes of Speaker McCarthy's meeting with President Biden, now pushed into next week. The ripple effects, of course, are going to come down to the one big question. Is a recession around the corner? Is the inflation story over? And for that, I love to look at NYMEX crude trading at a 70 handle, right at the cusp of dropping into the 60s. Is that the direction of travel for commodities? And what does that say about the broader macroeconomic trend? Is a recession just around the corner, Tom?
Yeah, and what will the OPEC Plus response be to that falling oil price? As you say, $70 a barrel on WTI. They're going to be meeting early June. We'll look for that potential cut coming through from OPEC Plus. Potential. Let's bring in Beata Mante now, City Head of European Equity Strategy. And let's go back to the macro themes around the debt ceiling then. Janet Yellen speaking to Bloomberg, saying the only good solution is raising the debt ceiling. What have you been saying to clients? What have you been hearing from clients about their concerns about the debt ceiling in the US? And what is your advice around how to position around this risk?
So I think equity markets globally and in Europe have so many reasons to worry about. And of course, debt ceiling is just another reason. And it's an immediate reason that we have a date for, right? But other reasons that equity should be worried about is, of course, deteriorating macroeconomic data, high inflation, persistent inflation, especially wage inflation, and recession, as you've mentioned before, right? So I think all of these together mean that perhaps the market is ready to take some profits. So we have this view of range trading markets this year. So the downside, we think, is limited by the fact that the market at least thinks that we've discovered the central bank's put through the earlier banks crisis. But the upside is also limited by all these worries we've just spoken about.
But you can also make the argument that the softer economic data underscores the view from some traders that you're going to get cuts by the end of this year. And we saw the jobless claims picking up out of the US. We saw producer prices coming in softer than expected. That is good news for the Fed. Does it also give grist to the mill to those who say you could be down to 4.3% by the end of the year?
if what the market is pricing in terms of the Fed funds is correct, definitely agree with you. It's a good news. But city economists actually disagree. We think that the central banks, the Fed, will stay the course for now. We have another 2 hikes going forward. And from the ECB, we have 3 hikes going forward. So ECB going for longer than the Fed. But I worry that where the market could be most wrong about is actually pricing in cuts too early. We think we'll have to wait a bit longer than the market thinks.
Beata, talk to us a little bit about fund flows here. It feels like in the post-COVID era, we had 2 years of where big tech in the U.S. was the trade du jour, followed by an immediate kind of fascination with Europe and emerging markets, the idea that anywhere but the U.S. was a good bid. Beata, in the context of these debt ceiling debates, to what extent are funds still going to be flowing to Europe?
That's the problem, of course, and we've already started to see outflows for the last 4 or 5 weeks. We've been seeing outflows from Europe and actually also from the US. So it's a worry for the overall equity space and perhaps a sign that for the time being the flows could go to the other asset classes.
Beata, grow cross-asset for us here. What is leading the European equity trade and arguably the U.S. equity trade as well? It felt like it started off with commodities being kind of this inverse trade with equities. Then it was the bond market. Where's the sensitivity right now when it comes to other financial assets?
So in terms of European equities, of course, we are just coming out of the 20% outperformance of the overall index over the US. It started back in October, and everything cyclical has, and especially banks, have led the index. And I think with the banks crisis that we've seen out of the US early in March, something has cracked in this trade, right? So my view is that we are going to see the continued flight into quality, away from cyclicals, away from value and into quality and growth with some defensive tilt.
And you touched on banks. You downgraded banks at the beginning of these travails. What would you need to see? What would the catalyst have to be to turn more constructive on banks?
We worry that the banks in the US have a bit more volatile future to come. In terms of European banks, actually, fundamentals look pretty good. Earnings come through very well. Liquidity looks good. They are cheap. So I think European banks are underwritten by all these positive categories. However, I think that this recessionary worries looming over us, even if it is just out of the US, means that for the time being, banks will have to wait. There will be a time to buy back into the banks, but we need to see some of these worries disappearing or us moving a bit
there's a little bit of value there in European banks, but you need to see a bit of those changes around the macro front to dip your toe back in.
Exactly, there is a lot of value. But
there's a lot of value, but not ready yet. Overweight UK equities, and yet the FTSE 100 very well last year, outperformed. This year to date, underperforming European and US equities. What is the case for UK equities?
So we get many questions about this call. It raises eyebrows of many people. Of course, last year it was the best market driven by the commodity strengths, but actually, I think, and I'm talking about FTSE 100 or MSCI UK index, it's a very particular index. So it is very heavy in commodities that drove the outperformance last year, but it actually has the biggest share of defensive sectors out there in the world, out of the major markets. And of course, in the time where defensives are quite expensive, these are international businesses that trade at big discount to their peers. So I think this is the attractiveness of the UK market going forward.
Beata, 30 seconds very quickly. What kind of metric do you look at when you evaluate the regionals here? Is it a purely valuation call now? Are we looking at the price to book ratio? How do you evaluate when the time to hop in to bank stocks is? What's the metric?
So there is no single metric, right, going forward. And really, one that I like the most is the credit conditions. You know, banks lending survey that, as we know, is coming down. So, of course, the banks are self-imposing a bit more risk of stand going forward, and They just don't want to be seen by the market as too risky. So I think that on its own is going to continue to drive the not huge underperformance, but underperformance of the banks for the near future.
Okay.
But these turning upside would definitely be a good sign.
Okay, Beata Mante of Citi, really great insights on the views around the banking space. Lots of value here in Europe, but not quite ready to lean into that trade yet. Overweight UK equities. Coming up, Janet Yellen says Congress raising the debt ceiling is the only good outcome for the debt standoff. Part of our exclusive interview with the Treasury Secretary is coming up next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Lyft CEO David Risher. That coming up at 1:30 p.m. New York, 6:30 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Tom McKenzie in London. U.S. Treasury Secretary Janet Yellen says there is no satisfactory solution to solving the debt limit other than Congress acting to raise the debt ceiling. She spoke exclusively with Bloomberg's Annmarie Hordern from the sidelines of the G7 meeting in Japan.
There is no satisfactory solution for the United States, a solution that will be good for the economy and financial markets, other than Congress acting to raise the debt ceiling. There are potential different paths that could be taken if that doesn't happen, but there is not a single thing that can be done that will save the United States from considerable economic and financial damage.
But this plan was outlined back in 2011, and you were there at the FOMC meeting about it, and it said that Treasury principals and securities would be paid. Is this something that, at least for contingency plan, has been discussed with the president?
So my understanding, I was at the Fed in 2011, is that this plan was never presented to the president and never approved. And
but would you present it now?
Look, we would. We are working full time to work with Congress to raise the debt ceiling. That's where our focus is. We know that the only good outcome is one in which Congress acts as it has many times, almost 80 times since 1960, to raise the debt ceiling. What global markets and American households and businesses need to see is that we have a Congress that's committed to paying the bills that we've incurred as a consequence of our legislation, that we're not a deadbeat country. And if Congress fails to do that, it really impairs our credit rating. We have to default on some obligation, whether it's treasuries or payments to Social Security recipients. That's something America hasn't done since 1789, and we shouldn't start now. So we've not discussed what to do. If that doesn't occur with the president, our focus is on getting it done.
Because as you know, treasuries are the bedrock of the global financial system. And the asset managers I speak to, the investors, they don't have the luxury of not contingency planning. So at this point, should they assume that debt may not be serviced if there's no deal?
Look, if Congress doesn't raise the debt ceiling, we face economic and financial catastrophe one way or the other. And that's why our focus is on making sure that Congress does raise the debt ceiling. I feel that that's something we're going to succeed at doing, and we're working hard to make sure that that gets done.
U.S. Treasury Secretary Janet Yellen speaking in an exclusive interview with Bloomberg's Annmarie Hordern at the G7 in Japan. Tom, economic catastrophe either way, saying the debt ceiling is the only option. I'm glad Annmarie Hordern didn't ask her about the $1 trillion coin, for example. I'm sure she would have thrown cold water on it. But it is really a key point that Annmarie specifically makes. A lot of the market doesn't know how to position for this.
A deadbeat country, wanting to avoid being a deadbeat country. Yes, how are you positioned around this? And every guest that we get on that we ask about this, the challenges on that risk and how to position that risk are clearly at the forefront of their minds. The politics, of course, at least today, the conversations that we're hearing from Washington is that at a staff level they're making some progress. The flip side to that, and this is something we get from others, is that the politics of today are that much more different. The right wing of the Republican Party, some would describe them as extremists, have that much more determination to push us to the limit, if not over the line.
Right, and even the deal, if it does in its current form somehow pass through, it still only pushes the kind of new debt ceiling limit to about March of 2024. So it's really just kicking the can down the road instead of finding a more sustainable solution. Tom, I'm curious, though, stateside, it feels like the panic is starting to build up, kind of like the negative anticipation before, say, Christmas Day. There's kind of that countdown. It feels like that with a negative lens. Do you feel that same panic in Europe?
The countdown to Christmas through a negative lens. I like the way you phrase that and characterise that. Look, there's still an element of us kind of waking up going, hang on a second, what, you guys are doing this again? You're putting us through this again? What, the 80th time? None of us have to do this. You set the budget, you get it through, you borrow the money you need. Yes, there is increased focus on this. Inevitably, we question ourselves sometimes, why are you running US stories at the top of the headlines once again? Well, because it is that important to all of us, not just you domestically in the US, of course. So let's hope they get it resolved. Plenty more, of course, of the coverage of Yellen, exclusive throughout the day. Sitting down with Annmarie Hordern. Coming up, a look at the key events and stocks you need to watch. These equity markets are in positive territory. Gains in Europe are 0.6%. The S&P E-minis stateside pointed to upside of 0.4%. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London, with Kriti Gupta in New York. Now, a look ahead at what is on the docket for today. Bank of England Chief Economist Hugh Pill speaks at 7:15 a.m. Eastern Time. That's after he got into a bit of hot water by suggesting that workers should not be asking for pay rises. At 8 a.m, it is Brazil CPI. Base effects will slow the year-over-year inflation rate in April closer to the 3.25% target for the year. That's followed by results from the University of Michigan Consumer Sentiment Survey at 10 a.m. To what extent are US consumers holding up as these rates continue to be pushed through by the Fed? And we get Russia CPI data. That's at 12 p.m.
Yeah, certainly a lot to digest on the macro front, but a lot to digest on the micro front too, Tom. Look, it's a Friday. People want to go home, but stocks are still trading, and there's a few that have already gained some momentum in the pre-market, specifically AT&T. This is a stock, Tom, that I find very interesting. It's one of those old guard tech telecom stocks, higher by about 0.4% in the pre-market right now. Look, they're talking about a fiber venture with BlackRock signing its very first subscribers. This is such a big deal stateside because, of course, we know there are patches of the country that still haven't hit 4G or 5G yet. So to really extend into a fiber network and directly compete with Verizon, it's a massive deal for AT&T at a time where they're bleeding subscribers.
Yeah, it's huge, isn't it? And I just wonder if it's a template as well in terms of how you push into those markets that, as you say, are underserved. And as you point out, putting them head to head with some of their competitors in that space as well. But Meta as well. This is fascinating in terms of the incorporation of artificial intelligence, all this focus around large language models.
It is, and pushing it higher by 0.6%. Meta specifically, though, said, we think of it as a big tech name. They said, look, we are not going to be investing in AI in the same way some of our peers are, and yet they are still kind of doing it, but just not in the kind of we're going to dive in all signal ahead for the way that Alphabet or Microsoft has been talking about AI as well. Meta instead looking, that's going to help with our ad tools. It's going to help target the people we want to see. And that's kind of a big deal. They use that magic phrase, artificial intelligence. It boosted the stock. It works like magic, Tom.
Yeah, the genie glitter, at least, the fairy glitter over at that stock on the back of AI. The consequence is really important, though. I've already met people who are using AI to create pitch decks, to create press releases, videos and stuff. So for advertising, really crucial in terms of how it develops and changes there. Tesla changing prices again, Kriti.
They are, and this is a really big deal for Tesla when we talk about just kind of scaling and bringing more affordable cars to the market, competing more directly with likes of Ford, GM, and other car makers around the world, by the way. But this time around, Tesla's talking about tweaking their prices, this time raising them instead of decreasing them. Something they talked about in their last earnings call was simply the idea that they aren't going to be able to make as much profit as they're trying to scale up. So instead, more volume, less prices to really build that brand value, to build that kind of really loyal base that a lot of Ford and GM has in middle America. And right now they're talking about raising prices by as much as $1,000, Tom. That will make a material difference to Tesla's bottom line.
Yeah, the margin's, what, 11% still? Much juicier than they are for the likes of Ford and GM over at Tesla, even as they slash those prices. You also, and we've also got a bit of a story around Twitter, change at the top there.
We do. And look, this also, now that Twitter is not a public company anymore, it does feed into the Tesla story. At the end of the day, that inverse correlation, the idea that Elon Musk's split focus is a negative for Tesla shares, that is a positive now this time around. As you see that overnight, Twitter is potentially going to get a new CEO, an NBC executive. Those talks are not confirmed yet, but it's certainly something that has been reported, which would put Elon Musk strictly in a kind of chief technology officer kind of role, according to his tweet last night, and perhaps return some of the focus to Tesla. That's something that, again, is boosting those shares this morning.
Hey, and you know what? We don't have enough female CEOs, do we, in Silicon Valley? So this is a new name atop of the list in terms of a big tech company and a female CEO. So that's good news. In terms of these equity markets, a little bit of optimism still holding on here, Kriti. Gains in Europe are 0.4%. Upside as well being flagged in the US. The S&P E-mini is currently pointing to gains of 0.4%. It's been a pleasure as ever, Kriti. That is it for Early Edition Surveillance. Is ahead, of course, with Tom, John and Lisa. We're going to hear from Goldman Sachs chief economist Jan Hatzius, among others. This is Bloomberg.